All about stocks this week. Volatile trade on Dalal Street. Markets end in the red. We'll tell you what your investment strategy should be. Infosys is the stock in focus this week. We'll tell you what you should be doing with your IT stocks. And we'll find out how Paras Edenwala managed to make 22% on his portfolio and beat the Nifty by over 12%. Welcome to All About Stocks, a show for long-term retail investors. On the next half hour, we're going to tell you what your investment strategy should be in these confusing markets. We'll tell you which stocks you should be buying right now to get rich over the long term. We'll also answer some of the questions you sent in during the week. Let me first bring in Ajay, my colleague, who will give us an update on how the markets performed. And Ajay, of course, Infosys that saw that huge correction this week. Take us through what happened.
Well, Faye, for this week, for Indian equities, consolidation was the theme pretty much across the board. If you look at the benchmarks and Sensex Nifty, all of them have erased about 0.5% each. Same is the case with broader markets as well. Nifty seemed to be facing a lot of resistance above the 6,500 mark. Repeatedly around that mark there has been a resistance. We also saw some shifting of positions. So high beta counters, real estate, capital goods, banks, all of them saw some listless or range bound trades. In fact, the defensives were seen gaining. IT and pharma witnessed some buying coming in. Select mid caps were obviously active, but there was buying support from the FI side. They remained continuously buying. DIs, however, was selling, but there was support on a net basis. Fund flows were positive. However, the pressure area actually came from global shores. Global cues were not very supportive. China growth concerns are re-emerging at the horizon. Ukraine issue is also simmering and is back as far as the geopolitical situation is concerned, which was keeping gains under check. However, dealers believe that this is a buy on dips market going forward. Higher levels can be seen, so identify good quality companies and buy in cash side. In fact, out of the F&O and cash, it was the cash segment which was more active in trade this particular week. Going forward, it will be interesting how RBI reacts to a slew of positive macro data which has been coming. WPI, CPI, even IIP data for the month of February was slightly better than what the street was actually estimating. IT index overall is witnessing pressure, led by, of course, Infosys, because Shibu Lal, the CEO of Infosys, gave some slightly warning sign as far as the revenue guidance is concerned, and stock tanked very massively, about losing 10% this particular week. Brokerages community have lowered their revenue guidance as well as earning estimates on this particular issue. However, not all of them are as negative on this particular stock, saying that it's only a company specific short-term issue, will not really impact overall IT sector, which continues to remain in a structural uptrend.
All right, Ajay, thank you for joining us. Now we bring in Paras Edenwala, Managing Director and Principal Portfolio Manager at Capital Portfolio Advisors. Paras, it's always a pleasure to have you on this show. It does seem like everything is about the elections right now, but there's a certain amount of upheaval in our global markets as well. Should we keep at this point some portion of our money in cash, perhaps, because everything seems so volatile?
Yeah, I think that is definitely advisable, because you are going to be seeing heightened level of volatility, not only because of local reasons but also because of international reasons. And to be able to capitalize on any good opportunity, you need to have some cash right now. And such kind of volatility always throws up very interesting opportunities. So I think it is recommended that you have every investor has some cash available with them right now.
Well, Paras, are we done with this pre-election rally, or do you expect the market to move up further before May when we hear the election results? And which of the sectors do you expect to see the most volatility in between now and the election results?
I think very hard to predict as to how the markets are going to behave, but looks like that a large part of that pre-election rally, as most people would like to call it, is almost done. You might have some further upward move, if at all, before the downward move starts once again. I think it's all done, and we need to really be very careful about the kind of movements that we are seeing in various sectors. There are lots of infrastructure stocks that have moved up, in expectation of what can really happen after the elections. There are some banking stocks that have moved up. But the underlying problems in several of these troubled sectors, they continue to be weak. And therefore, investors need to be very careful before participating in these upward moving stocks.
Well, let's try and make this simpler, Paras. If I were to give you 100 rupees right now, to split across the market in specific sectors up until the elections, including a portion of which that you recommend should be in cash, how would you split up 100 rupees?
I would I would leave about 20% in cash, and the rest would be deployed in some IT stocks, in some auto ancillary stocks, and some automobile stocks, and selectively in banking stocks.
But when you say banking, are you now focusing only on private banking at this point, or do you see merit at all in PSU banks?
While I do see some merit in some PSU stocks, but a large part of that basket continues to be troubled. But there are some which have reported numbers which have been better than expectations, so one can really participate in them. But yes, my initial investment into banking would be into some of the private sector banks.
You talked about auto and auto ancillary. Can you tell us why you believe that the auto sector right now has hit the bottom and is now poised for a turnaround?
There is an expectation of a turnaround in the automobile sector. I don't think it has turned around completely, but looks like it's hit the bottom. And we might see some kind of an upward movement happening gradually. But the only reason that I'm positive on auto ancillary stocks is largely because of their forays into international markets. Those markets seem to have stabilized for many of the auto ancillary companies, and the growth is largely coming in from those markets rather than India. And if India also starts turning around in the second half of 2015, as is generally expected, then I think that could really be a double whammy for auto ancillaries, and the delta in profits and the top line could be very, very attractive.
Well, let's also talk about IT stocks. You did mention that you'd like to put some money in IT stocks at this point. If we focus on what happened with Infosys this week, that massive correction on your screen right now, that was Infosys this week, and the rest of the stocks that we saw in the sector that also came down with Infosys. Where do you see value right now in the IT sector? And for those of our viewers who are holding Infosys, is this time for them to panic?
Not really. I think Infosys certainly has been a little slow, as compared to what the expectations were in terms of the turnaround. While yes, there are things happening which are towards the positive, but kind of saying that in Q4, the turnover is going to be on the lower range of their target, certainly has unnerved some investors. But my sense is that it is taking a little while. The turnaround is definitely happening, albeit slowly, and Infosys will surely get back to the same kind of respect that it used to get earlier. So have patience, and Infosys should definitely, I think, start delivering on as per expectations.
All right, we have a question, in fact, that's coming from one of our viewers. Subrat has written in, he has 40 shares of Infosys, which he bought at 2,140 rupees. He wants to know if he should hold on to that stock. He's making a fair amount of profit at this point. Now, like you said, does it make sense to hold on then to Infosys? Could you give him a target he can watch out for?
I think Infosys is pretty attractively valued. It is going to take a little while, as I mentioned earlier, in terms of turnaround and delivering the numbers that people expect them to deliver. So if the investment horizon is at least 3 years, my sense is the returns should be very attractive, and the stock should outperform the market.
All right, we have a couple of more questions that have come in from viewers. Utpal has written in, 100 shares of Mindtree bought at 712 rupees. Should he continue to hold on to that stock? Mindtree ended the week at 1,471. Hold on to Mindtree as well, Paras?
Yes, absolutely. I think Mindtree is a very good stock and should keep on again outperforming the market as we move along.
It's time for us to take a look at our portfolio question of the week. Every week we look at the portfolio of one lucky viewer. Rohit Gupta is our viewer for this week. He sent in a list of stocks that he's been holding since 2009, and he wants to know how you think, Paras, the stocks will fare over the next 5 years. Top of his list, 200 shares of RIL, which he bought at 900 rupees. Obviously got in at a slightly high point there. But what's your call? How do you expect RIL to behave over the next 5 years?
Yeah, I think one can hold on to the stock, but do I really expect RIL to deliver returns which are significantly ahead of the market? Probably not. While the business to me seems very good, and whatever has happened on the policy front, if implemented, also augurs very well for RIL. But just because of the stock being or the company being in some or other controversy all the time, I think that to that extent the returns tend to get stymied. And therefore, my expectation from RIL in terms of returns over the next 5 years would be in line with the market.
He also has 150 shares of L&T which he bought at 562 rupees. You also hold L&T in your portfolio, Paras. Hold on to it some more.
Oh yes, absolutely. I think and the stock will really do very well as we move along.
I'm really liking Rohit's portfolio. He has 250 shares of ICICI Bank, which he bought at 400 rupees. Bought at 403 rupees, in fact. ICICI Bank ended the week at 12.15. Again, you talked about private banks a little earlier, Paras. ICICI topping that list?
Oh yes, I'm just wondering, whether he really needs any advice from us, because he's really picked up stocks very well. And ICICI Bank also should do very well as we move along. I think the valuations continue to be cheap.
Well, in fact, he does want your advice. He has sent us a little note. He wants to know if it makes sense to buy Jubilant Foods at these current levels. And also, given the rest of his portfolio, does Jubilant Foods make for a good fit?
Jubilant Foods too has a reasonable future, but would I buy the stock at the current valuations? Probably not. I think it's too expensive for the kind of growth that it is notching up, and probably can notch up in future. I think the best days for Jubilant Foods in terms of PE ratios, are over, and you will see further moderation happening in PE ratios.
Well, could you give him another recommendation then, Paras, to add to his portfolio, keeping in mind he wants to hold these for at least another 5 years? What do you think would make a good fit for the stocks he already has?
I think Shree Cement on a correction can definitely be bought. To me, I think once the cycle turns, the delta in profits for Shree Cement can be absolutely humongous. And to that extent, any price below 5,000 for Shree Cement would look an attractive buy.
All right, Shree Cement is on your screen right now. And if you have any more questions, you can write to us. Our email ID is on your screen. We'll take a very quick break. When we come back, Paras has picked out 2 stocks that you can buy at these levels for returns in the long term. We'll tell you what those stocks are on the other side. Don't go anywhere. Welcome back. You're watching All About Stocks on ET Now. Paras Edinwala spending time with us this weekend, helping us with a strategy for our long-term portfolios. Paras, in fact, has been kind enough to pick out 2 stocks that he believes will make sense at this point at these current levels. The first of the 2 stocks, Gabriel India. It's currently at 27.45. It's an auto ancillary company. Paras, a little while earlier on the show, you told us why you believe that the auto and the auto ancillary sectors will do well. But of all of the options within that sector, tell us why you've picked this one.
Gabriel India is one of the oldest auto ancillary companies and belongs to the Anand Group, which has only one company listed among its various auto ancillary companies. And Gabriel is one of the largest manufacturers of shock absorbers, struts and front forks. They cater to 2-wheelers, they cater to 4-wheelers and passenger cars. Just because of the slowdown in commercial vehicles, a significant part of the turnover comes in from 2-wheelers, where they have a 25% market share. They have about 15 to 20% of their turnover coming in from. They have a market share of about 17% in passenger vehicles and a market share of about 80% from commercial vehicles. My sense is over the next 1 to 1.5 years, as the CV segment turns around, you will see a significant delta coming in from the turnover coming in from the commercial vehicles, which is more profitable for the company as compared to 2-wheelers. And the company is also foraying very aggressively into exports. So exports also are a little more profitable than the domestic sales. So I think as the economy turns around, as the automobile segment turns around, you will see not only the top line growing, but the margins improving very significantly over the next 10 to 15 months. And if you look at the quality of balance sheet, it is almost debt-free. They have a debt to equity of just about 0.3 times, and they have been cutting off debt over the last 3 to 4 years. In fact, even in terms of expenditure, they're getting leaner and leaner by the year, and they've used this slowdown to make their profit and loss account more efficient, to make their facilities more efficient, and they've improved the productivity. So combining all of these together, the stock looks very attractive. It's available at just about 5.5 times on FY15 earnings for a conservatively estimated growth of about 10 to 15%. My target for the stock would be at least a 50% return from the current levels.
All right, Gabriel India, there is Paras's first recommendation. His second recommendation is NBCC, the National Buildings Construction Corporation. It's a public sector project management consultancy company. It also does a fair amount of real estate development. Paras, this has been a sector that's gone through so much, and we know there's a terrible liquidity crisis in the real estate sector at this point. Tell us why we should be betting on a real estate consultancy company.
This is a company which, as they say, it's a project consultancy company, which is 90% owned by the government of India. Normally, I would stay clear of PSUs, but this is a PSU which really caught my eye, due to which, by the manner in which they are really working. They take up government colonies across the country for refurbishment or maintenance, and in terms, at times even redevelopment. The returns out of that in terms of return on capital employed are very, very attractive at 30% plus. The company over the last 3 quarters has grown at a clip of more than 30-35%, and the margins have also been improving quarter after quarter. As we speak, they have close to 20,000 crores of order book only from this business, which comprises of almost 80% of the turnover. The balance 20% comes in from real estate, where they build, take up projects, build up buildings, and sell it to the retail guys. But that is only 20% of the turnover. A large part of that 80% comes in from, as I mentioned, refurbishment, which is much more visible and much more predictable. If you look at their balance sheet quality, again, they have 1,500 crores of cash. For a company which has market cap of 1,700 crores and 1,500 crores of cash, which means the enterprise value is just about 250 crores. The company should do a net profit of about 240 crores in the current year. And therefore, if you look at the enterprise value to net profits, it's available at just about 1 time, which I think is ridiculously priced for a company which is notching up growth, which has a very good market share in its area of operation. And the government is fully committed, the promoters are fully committed into the area of business. On a PE basis, it's available at just about 6 times on FY15 earnings. And I would certainly expect 30 to 35% return over the next 1 year.
All right, 2 recommendations there from Paras, Gabriel India and NBCC. If you have any questions about those stocks, feel free to write to us. We'll have Paras answer your questions for you. Let's take some of the queries that came in. Purvin has written in 150 shares of Bharti Infratel at 210 rupees. Should he hold on to that stock? What's your call, Paras?
I'm not very comfortable on the tower businesses. I think if one has to take an exposure in telecom, it's better to take exposure in something like an Idea at the current levels rather than be invested in Bharti Infratel.
All right, let's take a look at another portfolio. Karthik has written in, he sent in a list of shares that he has in his portfolio. He wants us to help him decide which of these he should hold on to. He has 280 shares of Ashok Leyland, which he bought at 35 rupees. What's your call on Ashok Leyland, Paras?
Ashok Leyland has again been a troubled company, but the new MD seems to be kind of aggressively cutting costs and improving the product portfolio. As the economy turns around, my sense is the company should start doing very well. And my recommendation would be a hold at the current levels.
All right. The next stock on his list is Balrampur Chini, which he bought at 73 rupees a stock. Ended the week at about 52. What's your call on Balrampur Chini? Should he hold on to it?
I've never liked the sugar sector. Looks like the problems in Brazil are helping the sector right now. So maybe if there is another 10 to 15% uptick in Balrampur Chini, one should really exit.
GMR Infra, which he bought at 26 rupees. He also has GVK Power, which he bought at 18 rupees. Let's talk about GMR Infra first. Hold on to that stock?
Yes, I think with the elections around the corner and expectation of a government which will really push infrastructure, my recommendation would be a hold at the current levels.
And GVK Power, then, will that also apply for GVK Power and the entire power sector, that the expectation of a stable government and a boost to the entire economy is what it's going to take to revive our power sector?
Yes, absolutely. I think these stocks are anyway beaten down, and therefore the downside is limited. The upside can be reasonably good if you have an infrastructure-oriented government.
All right, last stock on his list, he has Rallis India, which he bought at 150 rupees. Hold on to this stock as well, Paras?
Oh yeah. I think the company should do well because the crop protection segment in which it is the market leader is expected to do well as we move along.
Right, time for us to take another quick break. When we come back, we'll review Paras's own portfolio. We'll talk about stocks like PVR and Tata Motors. Don't go anywhere. Welcome back. You're watching All About Stocks on ET Now. Thank you for staying with us. Paras Agenwala is still with us. He's helping us choose stocks for our long-term portfolios. Now it's time to take a look at Paras's own portfolio. Now, he designed this portfolio on the 7th of December 2012 for this very show. It's currently at an overall gain of over 22%. Now the Nifty over the same period is up 10%, which means this portfolio has beaten the market by 12%. I'm going to take you through the stocks that we have in this portfolio right now. There's Axis Bank, TCS, L&T, Tata Motors, Sun Pharma, Motherson Sumi, Tata Steel, Bajaj Finance, PVR and Shubha Developers. Well, if you look at the portfolio, Paras, it's doing really well right now. Would you like to make any changes in this portfolio?
No, I think I'm fine with the current constituents. While some of them have underperformed, but over the next 3 years, the portfolio should continue to outperform.
Well, let's talk about Sun Pharma. It's done really well for the portfolio so far. It's up about 66% since we bought it, but we know the US FDA has banned imports from the particular Gujarat facility. How much do you expect this to hurt the interests of the company?
I think the impact on the numbers will be less than 5%, and therefore I think it's too insignificant an amount, to be worried about. So whatever correction that we've seen in the company probably will be taken care of gradually. So I wouldn't be too concerned.
All right, so no changes there for the portfolio, and we're sitting tight on Sun Pharma as well. I'm going to give you a recap of this portfolio. It's one of our top performers on the show. And if you have any questions about any of these stocks for Paras, you can always write into us. These are the stocks he's picked for us. There's Axis Bank, TCS, L&T, Tata Motors, Sun Pharma, Motherson Sumi, Tata Steel, Bajaj Finance, PVR and Shubha Developers. Paras, thank you so much for spending time with us this week and answering all of our questions. We look forward to having you back again very soon. You remember, you can find a copy of this show on our Facebook page and you can reach me on Twitter. Thanks for watching.